Welcome to The Weekly Trend, a podcast for navigating the markets through the lens of technical analysis. The Weekly Trend podcast is provided for educational purposes only and does not constitute any professional advice. Listeners should not act upon the information or content without first seeking advice from a registered financial planner.
Welcome back to the Weekly Trend podcast. Today is Friday, September 29th, 2023. S&P 500 currently sitting at 4278. I'm David Zarling. I'm here sitting with the president of the Private Turf Management Society, Ian McMillan. Plenty to cover this week. Where would you like to start?
Yeah, interesting week. A decent range coming off last week. We're right back, so for the S&P specifically, right back at those August 2022 highs at 4280-ish.
Well, that's a level that we had talked about a little bit last week. That's an important inflection point, if you will. I know that can be an overused term. Yeah, you like to see those hold. Previous high becoming now, if this could be a sustained low in the market. When I use the term market, I use that loosely, right? We're talking about the S&P 500, which has its own market cap dynamics associated with it. But if you could see that low hold, that'd be great. But we're at the end of the month, right? Last trading day of September, it was a negative month for the market as a whole.
A negative month.
And I'm not just talking about the S&P 500.
Yeah, everything. Qs, S&P, Russell down 4.5 for the month. Last week was a rough week. Unfortunately, for the most part, got follow through. IWM, like we said last week, back below 180. Kind of tried to bounce back up into that area yesterday and this morning and quickly sold off. So no recovery there yet.
Well, and every single sector for the month down, with the exception of energy, using XLE.
Makes sense.
So energy positive 2.3%. But when we look across the board, utilities down 7.7%. And forgive me, I'm using pre-closing prices. We're a couple hours here from close, but we're going to be pretty close. Real estate down 7.5, industrials down 5.7, staples down 5.7, healthcare down 3.8, S&P currently sitting around minus 3.5, financials 3, discretionary almost 3, communication services about down 1%, and then energy positive.
Energy also the only positive sector over the last 2 months.
Yeah, we could argue that's relative strength, correct? If you were to say an intermediate or not even intermediate, a near-term top in the market, and topos can be a confusing term to use because that makes an assumption of a top or the top. But the S&P, in essence, since the beginning of August, has moved lower. I mean, is that a corrective mode since the beginning of August using something like the S&P 500?
Yeah.
Most instruments for that part.
And that's when most of the sectors started to peak right, the last few days of July and August 1st. And you've only had energy, as you mentioned, continue higher. And it's been all parts of energy. Certainly been your relative winners as of late.
And we've seen small caps get discounted since the end of July, beginning of August. If I could paint that picture, I could take you back in time. If we could do a little time travel, Michael J. Fox style, and go back to the end of July, just 2 months ago, and you had that small caps using something like IWM, an ETF that represents it, into a horizontal level that has been resistance for now going back to April of 2022. And that's that 198-200 level. That was resistance in August of 2022. It was resistance in February of 2023. And now we have ongoing proof that it was resistance going into the end of July 2023. And now you have the small caps, pretty good representation market-wise. I'm not saying it's the S&P 500, but it represents a good contingent of stocks that are now sitting relatively flat on the year, barely positive. You look at micro caps, which are the next batch We're sitting
now,
negative on the year.
With the Russell specifically, and I think just because visually it's easier to conceptualize this on something like the Russell than microcaps, although the microcaps have been worse, is unfortunately, I think the thesis is back on the table that, if this was just a big consolidation the last however many months since, we'll call it, we've been in this range in the Russell for
It's a long time.
18 months. We were at 188 January 2022. We're just at 188 earlier this month. Was this just energy for another downside move, which would be pretty unfortunate?
Yeah, it would be. And the clues that we would have if stocks as a whole were moving lower for longer, imagine that term, would be staying below a 200-day moving average for something like small caps, getting below a 200-day moving average for something like the S&P 500.
Yeah, that's probably get you below 4180 too.
Right. So the 200-day moving average for the S&P 500, a cap-weighted index, is currently sitting at 41.99. And as you alluded to, that puts us below 4180. If we were to close below that level, and 4180 being an important horizontal level, and that's where an area where sellers have shown up in the past, that'd be an area where we'd be looking for support for buyers to show up. Now, whether that happens or not is TBD. Whether we even reach that level or not is to be determined. And when we look back in time, what is interesting from a math and calculation standpoint is a 200-day moving average, Ian, is what? It's 200 trading days of information. So if we look back, 200 trading days, the data that would be dropping off the backside is around mid-December of 2022. And that price data is lower. So you would continue to see an acceleration or a move upward in the 200-day moving average while we correct in price. Is all of this just a normal correction back into the 200-day moving average? Do you have thoughts on that?
Yeah, certainly could be. I don't like that 2 of the 4 major indices are below. The Dow is back below its 200-day, correct? Yeah.
What did you say, 2 of the 4?
2 of the 4. So I get that S&P and the NASDAQ would be above.
Okay.
Russell and Dow below.
Yeah, no, that's a good point. And nothing good. Paul Tudor Jones,
even the Dow 200 days flattening out, it had started had started to turn up, even going back to March, and so maybe not enough of a, I guess, for lack of a better word, consistent price thrust to truly turn the boat. We're trying to turn the boat here, trying to turn the aircraft carrier, that is the 200-day moving average, and both the Dow and the Russell are really, really struggling.
Well, that's an excellent point, because the 200-day moving average is exactly that, the prior 200 days of information. And if your 200 days of information are flat, that literally means you're in a trendless environment. And that's what we're seeing out of small caps. And we know that Paul Tudor Jones, one of the best investors of this half century, said that nothing good happens below a 200-day moving average. And so those indices that are below them, caution is warranted. Now, it is helpful that the S&P 500 is still above, that you have the Qs still above. But this goes back to your point that you made last week and maybe even a couple episodes before that, that this has just been the weakest start for small caps on a potential new cycle higher that we've seen in recent history. And we need to see that broadening out. We need to see, like, we study supply and demand, we study relationships. When we study small caps versus large caps, what are we seeing there? Like, if we look at the Russell 2000 and divide it by the S&P 500,
that's pretty weak.
I believe we're below the COVID lows, with the potential of reclaiming those lows, which would be hugely advantageous and might be signaling a rotation back into a broadening out.
Yeah, and we had a little bit of a momentum divergence that didn't. Golly, these things just, when I say these things, I'm talking about small cap stocks, just
right.
a relative basis. Obviously, as we've talked about, pretty rough on an absolute basis. And the NASDAQ, okay, yeah, it's been the best. But it's holding up in its range a little bit better. We'll see how much. Certainly don't want to end up with a bullish or a bearish engulfing today. That'd be like our fourth one since, or at least on the S&P, we were kind of somewhat close. Obviously, we have an hour and a half, but I mean, this has been a sell of the pop environment. If you look at July 27th, August 24th, September 20th, all bearish engulfing candles here at the highs underneath 4,600.
And that fits the seasonality of the era, right? And really that weakness, that potential weakness, seasonality wise, doesn't end until mid-October. So you could see further weakness in this first part of October. And what's interesting about, and I don't know if interesting is the right term, but I'm going to use it, is just if I can take a step back and paint for our listeners this range that's existed in something like the S&P 500 that does go back to April of 2022. The market has moved sideways. It wasn't a corrective mode. We clear that level in June of 2023. We finally get above 4180. And where are we sitting right now? 100 points above that.
Yeah.
So what does that cause? Investor exhaustion, right? Because you broke above that level, you're now retesting it. It feels like the market, and because it has moved nowhere.
Yeah, basically moved 1%.
Right. It's moved 1% in well over a year and a half now. And that's exhausting. And so it's important to keep in mind that we're still above 4180. We're still above a rising 200-day moving average when we use the S&P 500 as our gauge or the NASDAQ 100. There are some warning signs with the way the Russell's performing. Even micro caps are performing. Those need to hold up. This goes back to the last episode where we talked about October being an amplifying month. Do we see amplification to the downside? We could, absolutely. Thankfully, we have price to tell us if we're back below 4180, if we're back below a 200-day moving average, that would be indicating more supply than demand and ongoing market weakness. Until that, though, this could be just normal seasonal behavior where we're correcting into October, mid-October, and retesting prior levels at where sellers had been. Now we're going to see if there's buyers there. That would be called price discovery. I get it. Price discovery is not as exciting as GDP.
GDP.
Yeah, gross domestic product, which we just got a report, and a really great contributor online, Mike Zaccardi, pointed this out, that they revised all sorts of GDP this past week, the reporting on gross domestic product. I mean,
and that's why I had to revise my portfolio.
Yeah, right. Like, imagine if they revised things in price, but they went back, the Bureau of Economic Analysis. Think about that.
Think about how smart those guys are.
Yeah. Can you imagine that there's taxpayer money that goes to a Bureau of Economic Analysis?
Well, they're probably worth their weight.
Yeah, 100%. And so they had a downward adjustment of GDP growth in 2022 and 2021. Shocking. Didn't price show us that ahead of time, which is a future discounting mechanism? And so now we look at.
They changed 2020 and 2021?
Yes, downwards, which we already saw the correction. Like, most stocks were correcting since February and March of 2021. The broader indices started correcting.
Imagine if they came out and were just like, never mind. Stocks didn't go up. Stocks didn't do what you thought they did in 2020 for 2 years.
Just revised stocks.
We've taken a look at the numbers and we've decided that that's just not what happened.
So one of the critiques of technical analysis, the study of supply and demand and the study of price, is that it's backward looking. And to me, I sit there and go, well, first of all, please let me know when you have future data. It's kind of crazy if you can travel to the future and get me that data. B, or secondly, what isn't backward looking? Like, GDP is backward looking. Earnings are backward looking, and they get revised all the time. Imagine if you bought and sold a stock and 6 months later they said, hey, actually, that sale of that stock that you did we're revising the price on that because we were wrong. And that's the beauty of price discovery is it's looking out. It's a price discovery mechanism or discounting mechanism. We're going to look out 6 to 18 months in the future. And here we had stocks weak, the majority of stocks weak since the first part of 2021, and the broad indices correct from January of 2022 into October of 2022. Now are just getting GDP getting revised lower for those two periods. It's almost like price knew before GDP. Isn't that crazy?
Man, I always knew that they could revise it by quarter, but I didn't know that they could go back multiple years and then just say oh, this actually didn't happen.
Yeah. It's
just didn't happen the way we all thought it did.
Yeah, bizarro world. But I mean, it came from the Bureau of Economic Analysis, though, Ian.
All those PhDs.
Yeah, crazy.
There's a lot of thought leaders in there.
Right. Thought leaders? Good buzzword. Fact pattern. So what we could do at this point in this episode is just talk about what we do have data-wise. We're not going to focus on earnings, revised earnings, GDP, revised GDP. We'll let the bureaus handle that. We'll focus on price. And one thing that is interesting is this corrective period from the beginning of August through now. We are entering kind of a critical, from a technical standpoint, not only from a price level. So this 4180 to 4280, the previous August high using the S&P 500, or maybe you want to use microcaps and look at IWC, and you want to look at 100 level. And I know in the past you've looked at the NYA. We're still below 16,000.
16, yeah.
When we look at the measurements of breadth, like the participation of stocks, we're at this level of when we look at percentage of stocks in the S&P 500 above their 50-day moving average. It's really at a point of this is kind of where you see a flush and a move higher, a correction and a move higher. However, we could also move lower from here, and that would be an acceleration. This goes back to the amplification of what could be October. And then we have almost 40% of stocks within the S&P 500 that have a momentum divergence. And that divergence is probably most likely have to do with, if you look at the S&P 500 and you're looking at the prior months and where the low was, and then comparing to where the low is today. So the mid-August was an initial low. The momentum at that point compared to now, we're seeing divergences. And so we could see a resumption of an uptrend here, but in the end, don't we just need to see buyers show up and price move higher, stop going lower?
Someone's got to show up and buy.
They do.
I've done all I'm willing to do.
And so from a sector basis, or it could be a sub-industry basis, could be international, could be crypto, could be commodities, could be bonds, anything that you're noticing, Ian, that is, making you sit up and take notice or is notable that you'd like our listeners to know about?
Gold pretty weak.
Okay.
Not a great inflation hedge.
That's a good point. You're just saying that the common mantra is gold is an inflation hedge, but yeah, we've seen gold lower during an inflationary period.
Yeah. Bitcoin, nothing really. 26. I mean, it's the same spot we were at last Friday, basically.
So no change there.
25, 26, 26.
Gold is not improved. When we talked earlier in the episode about energy leading, what are we seeing out of energy commodities?
Crude, obviously. I guess it's given a little bit back. We kind of got up in here to 95, back down to 90 here. I guess we got up to 94. But yeah, back down to 90. Yeah, this has been a big move for crude. No really momentum RSI divergence. Pretty strong. Nat gas, our friend Nat gas, still pretty range bound. This has been, I guess, down here under 3. Although, I mean, building a nice base back up above a 200-day. Now, that's a harshly downward sloping 200-day.
Yeah, looking at natural gas futures.
Yeah. But, yeah, I mean, you get above $3 and...
Yeah, I was just going to say, and that's priced in BTUs. What is that priced in? What are we pricing natural gas in?
BTU something thermal units. British? No.
Oh
Is it
yeah,
British?
yeah. And
Yeah.
it's from Henry Hub, and
Henry
it's
Hub.
dollars per million BTU. You talked about that $3. That's $3 per
Where's
million.
Henry Hub at? Is that like Oklahoma, Texas?
Ooh, let's look. Henry Hub, and the reason why I say that is because that's where a lot of like oil and gas refining happen. I apologize. Did I interrupt you? Did you say where it was?
No, or maybe it could be Louisiana, maybe.
That would make sense to me as a port. It is a Wraith. I could be saying that wrong. So if you're from Louisiana, ERATH, I'm going to say a Wraith, but I also know how Carolinas, Carolinians, South Carolinians, North Carolinians say
Maybe
Wisconsin
like
names. Yeah.
Right.
It's the delivery location for futures contracts. And it makes sense, right? That's where I think one of the larger liquid natural gas ports in the world are. But your point remains that $3 level on natural gas is an important one. It's happening into a declining 200-day moving average. Does that resolve higher? No idea. All I know is it's much lower from the narrative-driven Ukrainian invasion where natural gas was going to go through the roof, and we've seen nothing but lower prices. Reminds me of wheat. And so we can't marry the narrative. Speaking of wheat, down again today. Meanwhile, we've got cattle futures ripping higher.
Ooh, cattle futures, sugar. I think I saw an orange juice chart in the last couple hours, and orange juice was moving. Yeah, look at that.
So you can't have your
All-time highs for orange juice. Orange juice has never been more expensive. Frozen concentrate orange juice,
right.
specifically, up about 600% in the last
Well, and
6 years.
And if you're a technician, right, you study supply and demand, you're a chartered market technician, and you look at the range on orange juice futures, with the bottom of the range being approximately 100, the top of the range being approximately 215, that's 115 points. We've now exceeded that target. If we look above 215, right, that would put us at 330. We're around that 350 level currently now. That base that goes back to 2015, 2016, we're now reaching target. Do we see orange juice cool off here? Would make sense if we did. Not all commodities are the same. Ian just got done talking about gold not doing that well. A downward
one futures contract of orange juice is
from a like what's
a measurement standpoint.
Oh boy, so it's frozen.
So and that's just like it's just a block.
Oh, it is. It's like
I guess
like a frozen block.
How is it delivered?
Not delivered with champagne, right? That's not a mimosa
Remember
delivery.
that orange juice? I don't even know if they still make this stuff, but it used to come in like a can.
Oh yeah. That still doesn't exist, where it's like in a can and you put it in the pitcher and add the water and mix it up, and that's your orange juice.
Well, like the tin, like I think you kept it in the freezer.
Yep, 100%.
Yeah. Okay.
I don't know this off the top of my head. I googled it. That it's a futures contract of orange juice is 15,000 pounds of orange juice solids.
I want to know what the solid looks like, though.
You're looking for the images of it. That would be pretty wild. Unfortunately, not in the top results on Google. It's all the very friendly pictures of orange juice in a glass, a mason jar with a straw with orange juices next to it. You're not getting the frozen block of orange juice delivered. I'm sure our clients would be ecstatic if we took physical delivery of orange juice, 15,000 pound blocks of orange juice out on our newly paved back parking lot. I'm sure they'd be ecstatic.
Well, it's about to get cold, so you can store it out there.
Yeah, that's a good point. So we talked a little bit about equities. We've talked about the weakness in August and September, heading into the first part of October, also weak. So for 2 consecutive months, the market is down, and I can say that safely from an indice perspective, as well as a broad stock breadth perspective. Some commodities are up, some are down. Crypto remains to be determined. Anything else like when we look at bonds, I think for me, treasuries, we got some new information in the past.
Continue to go lower.
Yeah. Like, so last week, Friday, we saw treasuries make a new low. They're making a new low this week. Does that continue? But I would also argue that if you look at something like TLT, where we are currently is a price level that was extremely important in February of 2011, April of 2010, June of 09, and June of 08. And so do we see support here and treasuries move higher and rates move lower? I don't think we'd be surprised by that. I'm not calling for that. I don't have no idea. All I know is that we've been in a pretty strong downtrend for treasuries credit as a whole, whether it's junk or aggregate or government based. So time will tell whether we see a rebound in those.
It's like the largest weekly volume ever on TLT.
Ooh, that's actually interesting information. And some would call that potential capitulation. What I will say is if you look across the spectrum of bonds, TLT, 20 plus year treasuries, making a low that is lower than October of 2022. Whereas you look at international bonds, international treasuries, if this were to turn into a low, there would be a higher low than October 2022. Same with bonds that we talked about last week, higher.
Mm-hmm.
And so the strength is in junk or international bonds versus domestic treasuries. Again, that 60-40 portfolio, if it's tilted heavily towards domestic treasuries, could be a little bit problematic. Anything else, Ian, you want to cover before we wrap up this episode?
Congrats to your Brewers on making the playoffs.
Hey, I'm hoping that we get to see the Braves. I appreciate the Braves taking care of business against the Cubs so that the Brewers could win the division. And now we see who the final piece wild card is for the National League. And I think, to be honest, the Braves are the team to beat. Their bottom four hitters are, for a lot of the teams, they're 2 through 5 hitters. Braves are a special team, man.
The offense is there.
Oh, dude, their bats are ridiculous. Pretty incredible. And so before we wrap up, as always, I want to make sure that we recognize those who support the podcast and allow it to function. One of those is the Adaptive Select ETF listed on the NYSE under ticker ADPV, which helps investors access two of the most prevalent factors in markets: momentum and relative strength. Adaptive Select, through proprietary identification methods, attempts to own the strongest 25 large cap stocks when the market is in an uptrend. And since not all market environments are the same, Adaptive Select seeks to prevent extended declines by moving to short-term treasury bills and cash during long-term market downtrends. Investors can find out more, including how to invest in ADPV, by visiting adpvetf.com or calling 1-833-880-5200. As always, investing involves risk, including possible loss of principal. Adaptive Select is distributed by Quasar Distributors, LLC. So, Ian, we've reached the end of our time. We appreciate our listeners tuning in and providing us high rankings. Thank you for your time, Ian. Anything else before we wrap up?
Nope. Just wish everyone a happy weekend.
Excellent. Take care, everyone.